Hey everyone, welcome back to the channel. Today, we're diving into the fascinating world of the foreign exchange market, or Forex as it's commonly known. Whether you're looking to understand how global currencies interact or just curious about how money moves across borders, this video will give you a clear, engaging overview. So let's get started. Understanding the foreign exchange market, or Forex, is essential. The foreign exchange market is a global marketplace where currencies are traded. This market is crucial for international trade and investment because it facilitates currency conversion. For instance, if a US company wants to buy goods from Japan, they need to exchange US dollars for Japanese yen. Forex provides the mechanism for this conversion. There are two main segments within the Forex market: the customer market and the interbank market. The customer market includes individuals, businesses, and institutions that need to exchange currencies for practical purposes, such as travel or international trade. The interbank market is where large financial institutions, including banks, trade currencies amongst themselves. It's where the bulk of trading occurs, and it operates 24 hours a day, 5 days a week. Transactions in the Forex market can be categorized primarily into spot transactions and derivatives. Spot transactions are straightforward currency exchanges where the transaction is settled on the spot or within 2 business days. If you buy euros today, you'll get them in a couple of days. Forward contracts are agreements that lock in a price for exchanging currencies at a future date. They are used to hedge against potential future fluctuations in exchange rates. For example, if you expect the euro to strengthen in 3 months, you can lock in today's rate for a future transaction. Futures contracts are similar to forwards, but are traded on exchanges. They are standardized and come with specific contract sizes and expiration dates. They help manage risk, but are less flexible than forward contracts. Options contracts provide the right, but not the obligation, to exchange currencies at a specified rate before a particular date. Options offer flexibility because you can choose not to execute the trade if it's not advantageous. Swaps involve exchanging a certain amount of one currency for another, then reversing the transaction at a later date. They are used for liquidity management and to hedge against exchange rate fluctuations. The nature of Forex spot markets is quite dynamic and includes various instruments. Forward contracts allow participants to set exchange rates for future transactions. They are often customized and used by businesses to manage risk. Futures contracts are traded on exchanges with standardized terms, making them less flexible but more regulated. They provide a way to lock in rates and manage risk. Options contracts provide a strategic advantage by allowing you to buy or sell currencies at predetermined rates, offering potential for profit with limited risk. Swaps are useful for managing short-term liquidity and hedging against exchange rate risks, especially for businesses and financial institutions. Arbitrage and speculation in Forex. Arbitrage. In Forex, arbitrage involves taking advantage of price discrepancies between different markets. For example, arbitrage between banks, buying a currency at a lower price from one bank and selling it at a higher price at another. Inverse quotes and two-point arbitrage, using different currency pairs' prices to find discrepancies and profit from them. Cross-rate and three-point arbitrage, exploiting differences in exchange rates among 3 currencies to make a profit. Speculation. This involves predicting currency price movements to make a profit. Speculators buy currencies they expect to rise in value and sell currencies they expect to fall. This can be high risk but offers high rewards if predictions are accurate. Forex trading spreads. The spread is the difference between the bid price, which is what you can sell a currency for, and the ask price, which is what you can buy it for. A narrower spread indicates lower transaction costs and higher liquidity, while a wider spread can increase costs and reduce profitability. Exchange arithmetic. Understanding some basic arithmetic is crucial in Forex trading. The spread is the difference between the bid and ask prices. Premium and discount are terms used to describe the difference between the spot price and the forward price of a currency. A premium occurs when the forward price is higher, while a discount occurs when it is lower. International bond financing. Bonds are a key aspect of international finance, where entities raise funds by borrowing money and agreeing to pay it back with interest. Bonds can be debt financing, which involves borrowing funds that must be repaid with interest. Bonds are a common tool for this, offering a fixed return to investors. Equity financing involves raising funds by selling shares of the company. It doesn't require repayment, but dilutes ownership. Characteristics of bonds include par value, the amount the bond will be worth at maturity; coupon, the interest payment made to bondholders, usually at a fixed rate; maturity, the date when the bond will be repaid in full; and issuer, the entity that issues the bond, such as a government or corporation. Types of bonds. Government bonds are issued by national governments and are considered low risk. Municipal bonds are issued by local governments and are often tax-exempt. Corporate bonds are issued by companies, offering higher yields but with higher risk. Zero-coupon bonds are issued at a discount and do not pay periodic interest but are redeemed at face value. Euro bonds are issued in a currency different from the issuer's home currency. Foreign bonds are issued in a foreign country and denominated in that country's currency. Summary. To wrap it up, the Forex market is a dynamic space where currencies are traded, influenced by various factors like spot and forward markets, and arbitrage opportunities. Understanding spreads, exchange rates, and bond financing helps you grasp the bigger picture of global finance. If you enjoyed this breakdown and found it helpful, give us a thumbs up and subscribe for more awesome content. Drop your questions in the comments below, and I'll catch you in the next video.